Hello everybody, Julian Marchese here from MarcheseFinancial.com. It's been a while since I've made a video on the markets and what's going on with me. So in this video, I'm going to do exactly that. I'm going to share my thoughts on the markets, where I think markets are heading, and my economic views at this point, and also give you guys a little update on what's happening with me and what you guys can expect going forward. So followers of my Twitter and blog, MarcheseFinancial.com, would be able to see that over the last weekend, over a long weekend, I have made big changes to my website. My website is much easier to navigate through. It's much better looking, and it's a lot easier to share things with my followers and converse with them as well. It features a completely new, revamped style to begin with, and also ways to comment and connect with me. So that's a plus at first. And tomorrow is the start of the school season for me, so unfortunately I will not be able to update as often during the early hours of the day. However, active commentating, tweeting, and blog posts will continue on the later halves of the day, and my Seeking Alpha contributions and article posts will continue as well. So that's what's happening with me. Started the school season, got a busy first semester. Got English, mathematics, law, and chemistry for the next 5 months, so it's going to be a lot of work. However, it's not going to keep me away from my blogging and my market following and trading activities. So let's get into what I'm looking at in the markets right now. So followers of my Twitter and blog will know that I've actually switched to the short side in risk markets, specifically in US stocks, oil, and euros. So a couple of reasons for that. I was long going into the August doldrums, I guess is the best way to put it. You could see August was a very lackluster month in the S&P. Very small ranges on a day-to-day basis. We really only had 3 days in the month where we actually saw some movement. For the rest of the month, basically 90% of it was very low volume, hard to take profits. You had to be doing a little more size in order to get anything from it. Once again, volatility was just nowhere to be seen. And I believe that would continue. I thought we were going to see a continued push into new highs this month. However, there was a day, which was August 21st, where we did poke out through those highs, but we failed to retrace back to those highs. I was under the impression that we were going to see continued movement, based upon the belief that markets tend to probe new areas, and since we just briefly broke that area, I would imagine that we were going to retest that, and that's definitely a possibility. We could see it at the beginning of the month of September. But it was my belief that we were going to see a continued drift into new highs. Then September comes along, the economic calendar and political calendar in the United States and Europe specifically start to heat up in September, and we would see a reversal. September is also seasonally a bearish month for stock markets around the world. So we've got a lot of things coming up in the month of September, specifically centered around the central banks of the United States and Europe. Obviously, Europe is in a sovereign debt crisis and has been for basically the last 4 years. Greece is literally on the edge of bankruptcy and is potentially going to ask for a third bailout, which is probably very likely. Austerity is obviously not going well with the people of Greece and most of Southern Europe. And so I think there is still a lot of pain to come in Southern Europe, as I hate to say it. The numbers simply just don't add up in Greece and Spain as well. If you take a look at Spain, it has an unemployment rate, let me check here, of basically around 25%, 54% or so for people under 25. Now that is just an insane number, guys. I mean, if you take a look back at the Great Depression in the United States, same numbers, 20, 25% unemployment. And it really causes a snowball effect. Pessimism runs rampant in those countries with such high unemployment. Greece is at 23.1%, by the way. So you have pessimism, a contracted labor force, which obviously causes a decline in economic output. It's a snowball effect and can only be reversed by some new economic advantage or competitive advantage, as economists would call it, to cause a reversal in economic output and to see growth. And one of the ways we would be able to see that is if the currencies of these southern European countries were separated from the euro, and they would be able to decline appropriately to make those countries appear more attractive and to get their export markets running again. But unfortunately, the Eurozone is a monetary union, and most European leaders are adamant about keeping the monetary union together, specifically Germany's Chancellor Angela Merkel. And so the Eurozone is going to do whatever it takes to basically keep, as Mario Draghi said, to keep Greece and these faltering economies in the Eurozone, and to do so that will include more bailouts, more austerity, and basically more pain for the Greek people and, well, Europe in general. So, bottom line is that it's pretty much clear that the European economy will most likely continue to deteriorate in the coming years, and bailouts will obviously continue to add to debt levels as well. And the worsening European situation is probably going to continue to spread its plague throughout the global economy. That's just my opinion. And we have to consider it. If we do believe that Europe is going to continue to deteriorate, and that is my opinion right now, have markets priced in this pain? Personally, I don't think they have. Specifically, if we take a look at the euro, we are basically where we were just 2 years ago in 2010, if you remember that immense sell-off we had in the euro, which was expressed very highly in the euro, more as opposed to other risk markets like European stocks and commodities. So the euro hasn't really moved anywhere for the last 3 years. So I think there's a lot more potential to the downside, potentially even to parity on the euro, which is a long way to go lower. If, from a technical perspective, if we break this 120 level, that's definitely could be a target. Let's also take a look at oil. Oil is a great market to look at for global economic consumption. So usually when oil prices are rising, we are seeing economic growth, typically. And when oil prices are falling, global demand for commodities are waning, and thus a falling oil prices would tell us that the global economy is starting to slow down. So oil has risen from $75 or so to almost $100 a barrel over the last 10 weeks or so, after dropping from 110 to 75, which was a very steep drop. So once again, with oil, we really haven't moved anywhere. I mean, oil is really at the middle of its range for the past 2 years. So, answering this question, has the markets priced in pain yet? I don't think they have. So, from a longer term perspective, that's in the next few months, potentially a year or so, it's better. There's a better reward to risk opportunity to the short side. And as you know, guys, my investment philosophy, I guess you could put it, has heavy focus into reward to risk. So I'm looking for great reward to risk opportunities, usually more than 3 to 1 or 4 to 1. And right now, from a fundamental and technical perspective, I think these risk markets, specifically the S&P, oil, and the euro, are offering great opportunities to the short side from a reward to risk perspective. Now, let's take a look at the potential uh, the potential prospects for growth. So, as we know, what has really been supporting equity prices in the United States, at least? There's multiple reasons, and I've expressed these opinions and reasons in my previous blog posts and on Seeking Alpha as well. The major reason why we've seen such strength in U.S. equities is because global investors are basically forced to put their money into U.S. equities. If you're an investor and you need to put your money for the next couple of years into some asset class, where are you going to put it? You can't put it into Asia because China and Japan has been in their 20-year long depression and deflationary period, so usually investors are straying away from Japan. China has been recently hit by the global economic malaise, specifically in Europe, as China is a heavy export market. And with less consumption from Europe, its largest trading partner, the Chinese economy is being hit. Europe obviously is a no zone for global investors in equities and in the bond market, except for obviously German bonds and British bonds, so investors don't want to put money there. And in the US, we have treasuries or equities. Equities are still relatively cheap from a PE perspective, and a lot of US companies have lots of cash on hand. So that's a positive for U.S. companies first. They are showing lots of strength internally. And also, even with the uncertainty of the global economic environment, investors are trying to find yield somewhere, and really the only viable option seems to be equities and high-yield debt. So that's also been shown by the outperformance in high-yield bonds. You also, although it appears on this ETF that the high-yield bonds, which is HYG ETF, hasn't really moved over the past 3 years. If you count in dividend payments, which is roughly 7% a year, it has offered some great gains for investors. Going back to equity prices, equities are really the only thing that are offering some decent yield. If you look at treasuries, they basically have negative rates, real rates, and obviously German and British and Japanese bonds are basically also offering negative real rates. So investors are essentially forced to put their money into U.S. equities. You also have the support from the Federal Reserve, which has been huge in fueling the rally we have seen in U.S. equities. We've also seen a potential housing market recovery, which is bringing back some confidence into the consumer, although consumer confidence does remain quite low. So those are really our prospects for growth. Basically, we are just seeing the reason why we're seeing, and when I say growth, I don't mean economic growth, I mean basically rising equity prices and asset prices. The main fueler behind that is just easy money. As long as treasuries are not yielding basically anything and other regions around the world remain risky, investors are going to continue to put their money into U.S. equities. So that's the risk we have. So the risk is basically a indirect effect of global money flows. It's indirectly affecting asset prices, specifically equities and commodities. However, we do have an actual direct effect that could cause stock prices, oil prices, and the euro to fall quite greatly if the European economy continues to deteriorate, and that's the reward. So I believe, just from a fundamental picture, that the reward is much higher than the risk here. And from a short-term perspective, let's go to a daily chart on the S&P. I'm basically risking to new highs right now. I'm willing to, take a small loss here if the market does decide to move much higher from these areas, but I will be looking to short even if we continue to break two highs in the S&P, unless something major changes, majorly changes in Europe, Asia, or in the United States specifically. So that's my picture. That's what I'm looking at in the markets right now. I think, once again, that the short side is offering a better opportunity here. And if you guys want to follow more updates, what I'm doing, where I'm positioning, how I'm changing my positions, I would suggest that you follow my Twitter account, which is at Julian Marchese, and also my blog, my new blog, marchesefinancial.com. You guys will love it. I provide as much content as I possibly can, and I hope you guys enjoy it. Thanks for watching this video, everyone.